Well, good morning, everybody. This is Rick Dwyer, Chief Operating Officer of Tactive. And with me today is Keith Schneider, Head of MarketGauge. Welcome, Keith. How you doing today?
I'm doing well, thank you.
All right. So another interesting week in the market. So let's get right to it. The Feds, as we both know, increased the Fed rate by another 75 basis points. Like to get your feedback on what you think about that and how you think that's going to be affecting the markets.
Well, the 75 basis points is still going to leave the Fed well behind the rate of inflation, which is accelerating. And we're on a super cycle in commodities. That's something I lived through on the floor of all the New York commodity exchanges in the mid 70s. Even then, it was very cyclical, but long term, it really exploded. And it was quite a sight to see. And I think we're in that process at the moment as well. So with that, the Fed has to catch up. The only way it was broken was when Volcker came in and raised interest rates and ran it up to historic levels.
Do you think we're going to need to do something in this current environment, or is the jury still out?
Well, it's going to be a tough decision on the Fed's on the Fed. They're in a really tough corner. This situation has been brewing for 40 years, ever since the 1987 crash, when the Fed came in to halt the decline. You know, it's been doing that consistently. So in the past, the Fed had always been an independent arena, and its job was not to keep equity prices high. And after 40 years of doing this, we're starting to see unwinding. So all the stats that you see in terms of short-term sentiment, going back 15 years and saying we're oversold, we're seeing a once-in-a-lifetime type scenario and the unwinding of 40 years of inflationary monetary and fiscal policy.
So in other words, instead of the Feds being a support feature by going in the markets and buying, they're now unwinding at the same time they're increasing interest rates.
Exactly. So it's a compound effect, and where it ends, it's hard to know. Is short-term sentiment, and you look at the McClellan oscillator and all the classic advanced decline numbers, they all look at extremes, or if not extremes, at the lower levels, but it's nothing compared to what can happen in a longer term cycle. I mean, 2000 and the breaking of the internet bubble was a good example. We had stocks that went down 95% or more, or out of business. So that's the type of situation I think we're potentially in.
And, you know, to that point, we've already seen a number of companies, Peloton, Netflix, getting hammered. And I mean, there's a number of name brand stocks that are down 90–95% right now. So to your point, we're starting to see that happen again. Before we started talking today, you had mentioned that there's some structural things going on, and basically you said something is wrong. So why don't you explain your thought process on that to our advisors?
Well, one classic relationship is looking at whether things are in a risk-on environment and risk-off. A lot of the classic relationships are breaking down, which means that there's a structural issue. And one classic one is looking at the Australian dollar versus the Japanese yen. And the yen has absolutely collapsed. And the Australian dollar, on the other hand, has held up better. Now, of course, the Japanese monetary policy and what they did to support equity prices over the last 40 years or 30 years at least is unbelievable. So they own most of the Japanese equities. They're the largest holders. And of course, the Japanese stock market has not done well, and it hasn't even taken out the highs that was set in 1989 and 1990. So you've got a situation right now where classic relationships that would determine risk on, risk off has totally broken. That is telling you that something much more fundamental is at issue here.
So do you think we may see some of that also play over into Europe with interest rates starting to be raised over there?
I think it's going to play out on a global basis. Absolutely.
Okay. All right. Well, moving on, Keith, is there anything, I know we have the usual characters, but is there something that you think is maybe as dominant or more dominant than what's going on with inflation and interest that's impacting the markets and things that you and your team are watching?
Well, we're also monitoring the whole geopolitical situation because there's a lot of stress there as well. So you sort of have a trifecta going on here. Monetary policy, fiscal policy, geopolitics, excessive speculative bubble, crypto, the whole crypto space. I mean, just this week, in 1 week, crypto went from 30,000 to 20,000. That's a 30% drop in a week. Speculative assets definitely getting hit. And a lot of the classic data that you get from looking at oversold and sentiment readings, which are clearly over on the negative side, could still get worse. Mm-hmm. So you need to look at once in a lifetime or 2 or 3 time in a lifetime events and understand how those indicators work then. So don't get fooled by things are at an extreme and they're going back 5, 10, 15 years. No, this is historical right now.
Yeah, I think as you mentioned, it's a convergence of several different factors that we haven't experienced in my lifetime, where you have interest rates being raised at a time where you have inflation rampantly rising, and you have the Fed trying to do something that seems, no matter what they do, it's going to be impacting the other side of their mandate. So if they try and raise rates to lower inflation, they're also going to be slowing the economy. So what are your thoughts on that?
Well, they're definitely going to be, they're stuck. They're going to have to do it. I mean, one of the other factors, just going back in terms of how the market responds, is the rate of change of interest rates. And that's accelerating to the upside. So one thing that could give you a hint about maybe a potential bounce and a reversal, if the rate of change of interest rates rising slows for any reason, that might allow for a bounce in the market or a potential reversal. And again, everything is very fluid here. The inflation rate, even though it looks like it's a super cycle, could go on pause. And there was, other cycles within the bigger cycle, like in the 70s. So to me, that's the bigger model.
Okay. Well, let's kind of wrap up today's meeting, Keith, with your kind of gauge on where the market is right now. We have it from last week that you were kind of in the bearish camp. So once again, is MarketGauge looking at the current conditions as bullish, neutral, or bearish?
We're looking at it as still bearish, and it doesn't mean there's not opportunity out there. There are opportunities. We're definitely looking at metals, even though it's been really choppy. We think with Bitcoin, which definitely sucked money out of the gold and precious metals market, that now is under question. So as an alternative asset class, under these circumstances, could be interesting to keep an eye on.
Okay.
So there is plenty of opportunity still, as long as you're definitely careful and risk manage, because anyone and any premise can be wrong in the short term and also in the long term. So just be prepared to be wrong and take small losses. And every once in a while in this environment, you're going to catch some huge outliers.
Well, thank you, Keith. It's always a pleasure talking to you. So for everybody watching, if you have any questions for Keith or the people at MarketGauge and the whole team there, feel free to reach out to them. In the meantime, Keith, have a great weekend. Look forward to talking to you next week.
You too. Have a good long weekend.
Thank you, Keith.
Bye-bye now.